Hello everyone, this is Bhavik Chokshi over here and I hope you guys are doing well and studies are going in full swing. So in today's video, we are going to do a quick fire but a complete revision of CFA level 1 alternative investment in the shortest possible time along with the important questions of the numerical areas. So over here, alternative investment which appears in your session 2 and comes for approximately 7 to 10% weightage in the 2021 exams would have around 14 to around 18 MCQs in your main exams. So over here there are close to 7 readings and we'll do a quick revision for all of them and also cover some important questions. So let us get started. First of all, what do you mean by alternative investments? What are its features? What are its core characteristics? First, alternative investments are those investments which are other than traditional. So other than traditional bonds or listed shares are alternative investments. They can include various items like a venture capital investment, a private equity investment, a hedge fund, a mutual fund, a commodity, a real estate, maybe a digital asset like a cryptocurrency. The universe over here is quite different from the traditional investment universe. Now, why would I want to invest in maybe an alternative investment? Well, for starters, it will have a relatively lower correlation, like a Bitcoin has hardly any correlation with the stock prices, and as a result can provide great diversification benefits. At the same time, they can give you great returns. Why? Well, because they're relatively less liquid, and to enter over here you need specialized knowledge and an ability to take a decent amount of risk. Over here the time horizon over here is also fairly long as compared to maybe a public investment where you can buy and then sell in a few days, weeks or even months. But a private equity or a hedge fund investment will relatively have a relatively longer time frame. And the distinctive characteristics over here would be most of the times the investments that you have to do, let's say in real estate, in commodities, in bitcoins for example, is a direct investment and not an indirect one. Like in equities you can get an exposure like a mutual fund, even over here you can, but relatively more common route is a direct investment route. There will be some information symmetry, like when you look at alternative investment, data is not as freely available everywhere, and hence the fund managers will have a lot more specialized in detailed understanding as compared to the other general investors. And unlike equities or bonds where you have established market benchmarks or indexes, you will not have as much indexes to benchmark their performance, and hence performance of appraisal or evaluation might be slightly difficult. Next, you look at the classification. The broad classification over here will be private capital, which is made up of private equity as well as private debt. Then you have real assets, which can be made up of real estates, natural resources, infrastructure assets, and you will also have other assets like patents, collectibles, art, or even cryptos. And third is hedge funds. So over here throughout this entire material you are going to study more in detail for each of them. Like when you look at a private equity fund, a venture capital fund, or a leverage buyout, or when you look at private debt like distressed debt, etc. When you look at real assets, you will study about real estate, infrastructure investments, which can be social infrastructure, economic infrastructure, transportation, etc. and also regarding digital. So each of them will be done in a lot more depth over the entire material. Over here, if I want to invest into an alternative investment, there are 3 main routes. First, there would be a direct, first would be a fund investment where I will put money into a fund and that fund will go ahead and do the investment. Like if I want exposure to private companies or I want exposure to startups, I will invest my money in a private equity fund or a venture capital fund and they in turn will invest. Now the downside over here is they will take their own hefty share of fees, but the upside over here is they would have specialized knowledge and they would be able to manage this fund a lot better, and you will get diversification across various asset classes. So first there will be fund investing where you are investing in a fund and the fund will in turn go ahead and invest. Second is a co-investing route where you invest in a fund but at the same time the fund gives you a right to also co-invest. Like for example, if there is a venture capital or a private equity fund which is investing in a startup, you as an investor also independently get a chance to invest in a startup. Over here you get to learn from the fund manager where to invest, where to not, and the fund manager gets a chance to an additional tap of liquidity or money if a startup needs. Third is direct investing. Now this over here will help you definitely save fees because you are investing directly. However, this will involve a lot more time commitments. It will require a lot more specialized knowledge as compared to the other routes. So these are the 3 main routes for investing. Next, you will have the type of investment structure. Now, most of these funds who invest in these opportunities are structured as limited partnerships or limited liability companies, where if I am, let's say, someone like a BlackRock or a Blackstone, and I'm setting up a fund to invest in private equity, as Blackstone, I will be the investment manager and I will be the general partner who is in charge for management, etc. And the compensation for that is the fees. Maybe the fees will be a percentage of the assets which are committed or invested, and also linked to performance. At the same time, who will give you the money for making that investment? Well, there will be limited partners like pension funds or qualified or accredited investors who are investing over here. This capital, these general partners can deploy and earn a return, and a part of the return can be shared by the general partner, and on the capital invested you will also share the return with the limited partners. So the structure is typically a limited partnership which has general partners and limited partners, and there will be a limited liability agreement, LLP agreement, which will be binding them. However, the terms may not be uniform for all the partners, and hence if there are special terms for certain special partners, then for those special terms you will execute something called as a side letter, where apart from the standard limited partnership agreement, certain special terms which are affecting you will be mentioned in the side letters. Terms like excusal right or most favored right for a particular investor can be mentioned over here. If usually, like mutual funds, these funds are units which are listed. Typically private equity venture capital funds are not listed, but if there's a master limited partnership, in case of a master limited partnership, even the units of these funds can be listed, and hence may provide a bit of liquidity, though we are not very sure how much volume would be there, but at least a master limited partnership can give a little more liquidity, because the redemption over here or exit over here might be slightly difficult. Now fee structure is governed in this chapter and more so in detail in the next chapter, so we'll cover that, and we'll also try to do some numericals maybe now or maybe by the end of the video covering this specific aspect. So when you look at a fee structure for these funds, let us say you have a hedge fund or you have a private equity fund, the fee structure will have certain management fees, and these are fees which are linked to the assets that are being managed. Over here, if it is a private equity fund, then these fees, usually the structure over here is 2/20 structure, which means 2% of the total assets will be the management fee, whereas 20%, which is the return which is an incentive or a commission or a bonus, or sometimes called as a carry, on how much is the return which is generated. So there can be an investment management fee, which is usually 2%. Sometimes it's subject to negotiation, but the standard term is 2%. For a hedge fund, this is 2% of the assets under management. However, for a private equity or a venture capital fund, it is 2% of the committed capital. Now, what is the difference? If Blackstone raises a fund and let's say 100 million or a $100 million fund. Now, it is not necessary that Blackstone, who is investing in private equity companies, will have investment opportunities from the first day, and hence it may draw down only $20 million of capital, which means the remaining $80 million is not drawn down. It is still there with the limited partners who can use it. This is also called as dry powder, and as I keep on getting more and more opportunities, I will draw down more and more of the capital. Now, sometimes people might say that hedge funds usually end up investing even in public equities, and hence an investment opportunity is there all around. However, a private equity fund or venture capital fund has to scout and search a lot, and hence if you make them subjected to percentage of assets under management, they will be incentivized to draw down more of the capital and make hasty investments, and as a result they say, well, you know what, you want the fees, we'll give you 2% of the committed capital, let the money be with me as a limited partner till the time you have end use, then I will give it to you. So over here, for a private equity or a venture capital fund, this is usually a percentage of the committed capital, whereas for a hedge fund, this is usually a percentage of the assets under management, and usually this is around 1 to 2% of the fund's assets. You have to see the question on whether these are based on the opening assets or these are based on the closing assets. Most of the questions use closing assets, but that has to be given to you in the question. And the second type of fees are called as incentive fees. Now, incentive fees are based on the performance. Like, for example, there was 100 million and you have invested this. The general partner has invested this and the fund becomes 120 million. So over here, there is a return of 20 million. Now, this 20 million may say sum of the return, I mean, obviously you'll have to pay the management fee as well, but let us assume the incentive fee is independent of the management fee. So had there been no management fee, let us say incentive fee is 20% of the return generated. So the return generated is 20 million into 20% will be $4 million. And this is a $4 million that has to be paid to the general partner. The remaining 16 million can be enjoyed by the limited partners. Now, apart from this, there can also be a 2% of asset under management. So if this is 120 million into 2%, that is 2.4. Now you will have to see the question to figure out whether the incentive fee is net of the management fee or is the incentive fee independent of the management fee. So if it is net of the management fee, then I will say my return is 20 minus 2.4, that is around 117.6 into 20% will be given to the general partner. However, if my incentive fee is independent of the management fee, in which case $20 independent of the management fee is the return, of which 20% will be given to, let us say, the general partner. So this is what you have to remember. Now what can possibly happen is, over here, next year the fund may go down. Let us say today the fund is now 120 million minus 2.4 paid minus another 4 paid. So if I do the calculation, probably this comes to what, 116 and maybe, I mean, I'm not sure, 113.6. Let us say it comes to 113.6. The fund is at 113.6. In the next year, there's a 13.6 loss, in which case the fund goes down to 100. Now, I might still have to pay management fees, but there's no further incentive fee. However, the next year, I again make a $13 or a $14 return, in which case I will again, as a general partner, go out and demand incentive fee. Kyun? Because मैंने return generate किया. However, your return, I mean, you have already touched a high water mark of around, let's say 113, for example. You will get your incentive fee now if there's a high water mark clause, which is there in most of the funds, if you are able to beat the highest value your fund had reached in the earlier years. So if, let's say, your fund after all of this was at $100 and then maybe you earn a $20 return, the fund comes to $120. I will not get a return on the entire 20. I will say that the fund earlier, the highest watermark that was set was 113.6, and hence any return that you are earning above 113.6, for example 120 minus 113.6, maybe around 6.4. On that 6.4, you will earn the incentive fee, assuming this is independent of the management fee. So this is regarding high water mark, and there will be sums, problems that we will also practice. You should have also, because this has a very high probability of making it to your main exams. So there are certain special clauses for performance fees, like a high water mark, that is, you're going to get an incentive fee only if your fund's value crosses the maximum value that was reached earlier. There can be other clauses as well, like you can have a catch-up clause. What is a catch-up clause? Like, for example, or there can be other features as well, like a soft hurdle rate or a hard hurdle rate. Before you go to catch up and other clauses, these are most common. A soft hurdle rate means I will say that I will give you a return only if you are able to earn more than 8%. Itna to minimum kamana chahiye. Let us say management fee and incentive fee are independent. So over here, I will say if I've given you a fund of 100 into 1.08, 108 ke upar aapne kamaya only then, I mean technically, if you have earned 105, let us say there is a $5 return. But I mean, $5 is not much, and as a result, we will say that we will not pay you any incentive. $5 kamane ke liye thodi na we have given you for $5. We have not given you money, and hence there is a hurdle rate. Let us say it is 8%, which means if you earn more than 8%, only then will you get your incentive fee. Now, if let's say I was in the first year, my fund had $100 and the fund value reached $120, which means is it above 108? Bang on. Which means are you entitled to incentive fee? Perfect. However, incentive fee will be on what? Let us say it is independent of the management fee. It will be a percentage of what? Well, if it is a soft hurdle rate, the moment you cross the 108 barrier, then you are entitled to the incentive fee on the entire amount. So if your return is $20, then you will get the incentive fee as 20% on $20 once the soft hurdle rate is crossed. However, the hurdle rate is called as a hard hurdle rate, which means even if you earn more than 108, the incentive that you will get is not on the entire $20. We are saying that, okay, from 100 going to 108 was no big deal. If you've gone above 108, okay, the excess over that is your base for the purpose of incentive. So 120 minus 108, that is 12. Independent of the management fees, will be taken as a base for your incentive. So you'll have to see all of these terms very carefully before you kind of solve your problems, and there's a very high probability that a problem on this comes up in your main exams. So over here there is high water mark, there are hurdle rates, there's also something called as a catch-up clause. A catch-up clause would mean that I will first try to satisfy at least up to the hurdle rate my limited partners. So if my hurdle rate was 8%, I will say that if the fund is earning, let's say exactly 8 or 8.1, that is I'm crossing the hurdle rate, ideally that entire return will be 80-20. We are saying no, we will give, if the hurdle rate was 8% and I've earned 9.5%, then I will first give the 8% to the limited partners, and the excess above 1.5% will go to the general partners. Sir, but ideally 80-20 hona chahiye. If 20% was to be shared by the general partner, no. So till the time the hurdle rate is given to the limited partners, general partner will not share. Beyond that, the limited partner will not get till the time the general partner share is exhausted. Like for example, then if my return was not 9.5, the return was 11%, in which case the first 8% will be given to the limited partner, the next 2% will be given to the general partner, and once you give the 2% to the general partner, the excess 1% that is beyond 10 will then be shared between the limited partner and the general partner in the ratio of 20:80, assuming there is a 20% incentive to be paid to the general partner and 80% will go to the limited partner. So this is a catch-up clause, that you will first up to the hurdle rate give return to the limited partner, then the general partner will catch up for the share that they did not get, and once the general partner reaches that, like for example 8% and 2%, beyond that whatever excess return is there will be shared by both of them. So this is regarding what you say as the catch-up clause. Next, you have something called as a high water mark that we have discussed. Then there is waterfall. Now, what do you mean by waterfall? There is an American, there is a deal by deal waterfall, and there is a European, which is a whole of fund waterfall. So when you look at an American waterfall, if there is one deal where I've invested 100 and there is 120, and there is another deal where I've invested 100 and this becomes 90, there is investment 1 and investment 2. So if there is an American waterfall, I will say on the first deal I made $20, and $20 into 20%, this is $4, will go to the GP. It's a deal by deal sharing. In the second deal, I made a $10 loss. It is a loss, so there is no incentive. However, the general partner will end up getting $4. However, if it is a European waterfall, I will say, well, you know what, at the end of the day I've invested 200, at the end of the day 120 and 90, this will become 210, and hence what I've earned is $10 on the whole of fund, and on $10 you will get your 20% incentive fee. This is called as a European waterfall. Generally a European waterfall is considered to be more fair. But if I want to do the distribution on a deal by deal basis, I can even do that as an American waterfall. However, I can also add what is called as a clawback provision. What do you mean by clawback provision? A clawback provision means if there was a profitable deal, I gave some incentive to the general partner. Then if there's a later a loss-making deal, then that loss-making deal will eat out, clawback what was earlier paid. Like for example, in an American deal by deal structure like this, if at a later date, so first you paid 100 into 120, that is equal to 4. Now if there is a clawback clause, then $10 ka jo loss hai, on that $10 loss into 20%, and this is a negative $2. So over here there would be a negative $2 which is to be recovered from the general partner, and this is called as a clawback provision. You will do this at a lot of length even in the next chapter, and a lot of sums are there, at least in your material in the next chapter. But for now we'll practice maybe a few of them later. But this is rounding you through some of the most important clauses like hurdle rate, soft and hard, high water mark, waterfall, American and European, catch up, clawback provisions, etc. So that takes care of your first reading. Next you go to the second one. So over here you will have to figure out the performance appraisal of an alternative fund. We said that okay, we can do performance appraisal of a mutual fund, etc. Then what is the big deal about alternative investment funds? 4 important things are quite different over here in case of an alternative investment fund. First is the timing of cash flows. Now, unlike a mutual fund, etc., which can keep on generating positive returns from the very first year, the timing of cash flows over here are quite unique. Like, there'll be 3 distinct phases in a fund. Now, if a fund has close to 8 to 10 years life, the first phase is usually the capital commitment phase, where once I take capital commitments from my partners, I will try to search for opportunities and then I will draw down the commitments. At this point, I'm not really making returns. I've just invested in early stage companies, etc. And I'm just committing the capital from more and more limited partners. So this over here, in these years, there would be no positive cash flows and hence the returns would generally be negative. Second is the capital deployment stage, where you start deploying the capital. However, some companies might start turning profitable, some companies might still be loss making, and hence even in the capital deployment phase, though the returns start increasing, they may still be positive. And then there are bumper returns usually in the capital distribution phase. So this is the phase when the capital later gets distributed. So when I look at the timing of cash flows, there would be a J curve. A J curve over here would say that in the beginning, during the capital commitment as well as deployment stage to a great extent, the returns might be negative. However, in the capital distribution phase, the returns will be maximum, and as a result, you will have to compare funds of a similar vintage. Vintage mean years. You cannot compare a fund which is just 2 years old with another fund which is currently in its 8th year. This will not be a correct comparison, and hence it will not give meaningful comparisons. So first is the timing of cash flows. Second is leverage. A lot of times, especially hedge funds, end up taking leverage. Leverage would mean borrowing. They can actually borrow money to invest, or they can even short sell. Like for example, if I have $100 million with me, at best I will invest $100 million, but a hedge fund will identify certain overvalued securities, let's say about 20 million, they will short, that is they will sell $20 million of this stock, get money and use that to invest another 20 million. So you have, let's say, a 120 by 20 structure where you've invested 120 when you had only 100, and you have shorted 20 or you have borrowed 20. So this leverage magnifies the return. And how will you probably calculate the return in case of leverage? Like for example, if I had 120 invested in a company X which gave a 10% return, so my return will be 120 into 10% minus 20 rupees which I've shorted. But if I've shorted, then I would like if the price goes down, and let us say the price in fact goes down by 5%, in which case let us say 20 into 5%. So my return on my investment from my pocket, which is 100 only, you can say my investment is 120, but from my pocket I've invested 100 only. The remaining 20 I've either borrowed, I've shorted and got that 20. So over here this will be 12 plus negative will become positive. 12 plus 20 into 5%. I think this is equal to 1. 20 into 5% is equal to 1. So 12 plus 1, that is 13 upon 100. So this will give you, let us say, a 13% return. This is going to give us, let us say, a 13% return. So this is leverage, which will magnify the gains, and hence this will give us a 13% return. Okay. So when we look at this particular case, that is another special feature which is there in an alternative investment. Third is there can be illiquid investments. So when I look at most of the mutual funds, etc., the investments are very liquid, and hence their values can easily be determined. However, a private equity, venture capital, these investments that they make are quite illiquid, and they usually fall in the level 3 category of the fair value hierarchy. When you look at these investments, most of the times till they exit, valuers would gauge that the value of these investments is very close to the cost, and thereby subdue the standard deviations. Remember, dispersion zyada hoga nahi. If you are saying that okay, the value is almost equal to cost till the time you exit, in which case that there will be very less deviation, and hence it might appear that your performance is great when as a matter of fact you have not been able to correctly capture the standard deviation because you are not able to correctly find the value of these investments during those intermediate periods. So valuation sometimes is near initial cost, and hence it makes investment appear low risk when they're actually not. Fee structure, as we discussed earlier as well as next, we will see this is unique, and much higher fees are there over here as compared to a typical mutual fund, etc. Now, sometimes the measures that you want to see for performance can be an internal rate of return or an IRR over the life of the fund. Not just deployment phase, not just distribution phase, not just commitment phase, over the life, what is the overall IRR that is being earned? Or you can find a multiple on a simplistic basis that I at the end of the day raised 100 million and ultimately distributed close to 250 million. So there is a 2.5x, for example. So the measures of return will generally be done over the life, but when they are done, they're usually done by either measuring the IRR or sometimes even taking a multiple. Okay, over here, next you will go to interpretation of returns both before and above the fee, after fees. Now, we have discussed that to some extent, but when we look at alternative investment funds, there's a problem when it comes to redemptions. It is not as easy to exit these funds as a limited partner because there can be certain redemption charges or fees that have been put in, or there can be certain lockup periods, that is for the first 4 years you cannot claim a redemption, so the general partner can peacefully invest. Or even if you claim a redemption, there will be a notice period, maybe 60-90 days, after which you will get money because the general partner will need some time to generate that kind of liquidity to pay you. Or they can define a gate. A gate would be a time frame where an investor or a limited partner cannot claim redemptions. So there can be a lot of redemption restrictions. There can be negative returns in earlier years, so there can be more redemptions. So to avoid that, there can be a possibility of a lockup period, notice period, redemption fees, and even liquidity gates. The returns, as we said, are usually 2/20 returns, or even 1/10 in certain cases. Like a fund of funds might have 1/10, but most of the hedge funds or private equity funds have a 2/20 structure, but they are subjected to negotiations and special clauses which can be incorporated in the side letter. Like if I am committing money very early, like a founder, for example, I might demand lower fees. These are called as founder class ownerships, where you can negotiate a lower fee in a side letter. Or if I'm committing a very big amount, I'm giving you a big commitment, I can negotiate for a slightly lower fee. Or if I am demanding more liquidity, I'm saying that no, I don't want such lockup periods and notice periods, then they might say then in such a case, you'll have to give me a higher commission or higher management fee. So you will have to see if there is more commitment, then you can negotiate for low fees. If liquidity, if you want high liquidity, you should be prepared to pay higher fees. Founder class, if you're investing early, maybe you can get lower fees. Or sometimes there is an either or fee. Like you can either, you can agree to a 1% management fee or a 30% incentive fee, whichever of the two, not both of them. So it depends. There's a lot of negotiation which goes into this. Now, performance evaluation, when we say for AIF, it has to be sometimes based on some performance, like an index. If I have to figure out how well is my equity portfolio doing, I will compare it with the S&P 500, etc. And based on that, I will comment. However, for alternative investment funds, indexes are very less. You might not even have heard about any index. So indexes are not as much, and even if there are indexes, they are subjected to a lot of biases, which would mean something like a survivorship bias. Like a private equity or a hedge fund is not mandatorily required to disclose its investments, and as a result, who will disclose? Like in social media, who goes on social media and posts? Well, if you have a positive achievement or a positive thing, you actually show off. However, if there's something bad or a negative, you actually go into a shell. You don't really do all of that show off on social media. That same thing will apply even to a fund. If I have earned stellar returns, I don't mind disclosing. However, if my returns are quite subdued, I will not probably disclose it, or I might not even continue, in which case there's a survivorship bias where funds who are surviving are usually the successful ones, and hence the index, if you make, is only going to be based on the successful funds. Or there can be a backfill bias, like index can be subjected to rebalancing. You might include something, remove something, include something, remove something. But when you include a new constituent into the index, then that data, if I give for the comparative years, that data will also be comparatively restated, and hence I will usually include a company which is, there's a notion over here, selection bias bolo, backfill bias bolo. Over here there's a notion that you are going to invest a company. Selection bias would be that you'll select a good company, like in Nifty 50 in India, you have 50 top companies, but that is across sectors, but in those sectors you select the best companies of those sectors. There are also companies which are bleeding in that sector, so there's a selection bias. And once you select it, you'll also have to restate the past data of the index based on this constituent, in which case there will be a backfill bias. So over here there can be a survivorship bias in this index, and there will also be a backfill bias to include only successful funds. But if you have to do comparisons, you have to ensure that you compare across common vintage years. That is, funds who had started at the same point can be better compared to kind of give a better understanding. Okay, returns over here, total fees can be one made up of management fees. Usually this is a percentage of the committed capital. So if there is $100 million into 2%, that is 2. Again, this can be 2% of the opening or the closing. You have to see the question, though most questions of the institute we have seen are based on closing. Second, there is incentive fees. Now incentive fees is based on your performance. Now if there is no high water mark, no hurdle rate, nothing, and as we discussed earlier, if there's 120 which is a value, then 120 minus 100 which is equal to 20 your performance. Now you have to see whether you have to pay the incentive fee net of the management fee or independent of the management fee. If it is independent of the management fee, $20 into 20%, that is $4 will directly come over here. However, it is net of the management fee. Out of the $20 minus whatever is the incentive fee, or 2 or 2.4, you will subtract, and then on the remaining pay the incentive fee. Again, incentive fee is only to be paid, so your final return will be the return after all the fees, your investment. So if I go to see, for example, 120 minus 100 minus 2 management fee minus 4 incentive fee upon an investment of 100 will give me the return. This is my final return for a limited partner. Again, while doing so, as we discussed earlier, certain special clauses like a hurdle rate, soft or hard, high water mark, the maximum value that the fund had earlier reached, only beyond which you will give a return, or a waterfall, which is American, European, will have to be seen. And clawback clauses, if any, which are applicable, will also be reviewed at. So over here, this kind of takes care of this reading. An example if we have to discuss over here would be if there's a hedge fund whose value today is 100, management fee is 2% of the value, and performance fee is 20%. There's a 5% soft hurdle rate, and there's a high water mark, which means you will only pay once you cross the highest limit and all fees are net of the management fees. If in the first year the fund touches 100.2, I'm at 110 fund touches, so 2% over here is value of the initial. So I would say 110 into 2%, maybe this is 2.2, will be the initial management fee. There will be no incentive fee because over here you are making a loss, which means V1 would be over here 100.2 minus 2.2, and as a result your V1, I believe, would be around 98. Now when I go to V2, I need to see whether, yes, I'm making 119, but is it more than my soft hurdle? So I will do 98 into 1.08, which is my soft hurdle rate. Whatever I get, that is 105.84. So if my final fund return is greater than this, you are going to get the incentive fee. Over here, when I look at this, I would say that okay, my fund has made 119, however there would be some management fee. So if I look at the management fee, this is 2% of 98, and 2% of 98 will probably come to 98 into 0.02 will come to, let us say, 1.96. okay, now I'm still making a good enough return. Net of management fees 119 minus 1.96, 119 minus 1.96 will come to 117.04. Now this is higher than my earlier high water mark. What was my high water mark? My high water mark was 110. If it crosses 110, then only will I get the return, because there's a high water mark. The fund's value was once upon a time at least 110, and as a result, if I want to find the incentive fee, I will take my return above the high water mark, which is 117.04, which is net of the management fees, minus 110 earlier into 20%. So this is 117, this is 7.04 into 20% will come to, I think, 1.41, and hence if I were to find my percentage return, I will say 117.04, which is already after the management fees, minus 1.41, minus 117.04 minus 1.41 comes to 115.60, which is now the new high water mark, minus 98, which was originally there, upon 98 into 100. So over here this will be upon 98 into 100 will come to around maybe 17.98 or some percent, which will be your return. Okay, now in case of a fund, what I'm doing is I'm investing in funds of the other companies, and hence over here if my value is 60, there's a 1/10 fee structure, and M and P are independent. On a year-end value of alpha and beta, these are the two funds in which I've invested. 60 I've invested, it becomes what, 45, and 28 I believe 73, and hence over here there will be 1%, I think 1% of what, opening, then 1% of 60, and then 73 minus 60, that is 13 into 10% will be your incentive fee. So over here these are your incentive fees. Now if you look at waterfall or clawback, over here let us say this is investment and exit, carried interest, that is GP sharing 20%, there is no clawback in the beginning. If there was an American waterfall, if there's an European waterfall, if there's an American waterfall, 30 into 20%, that is 6 would be paid. If there's a there is a $20 loss and there is no clawback, nothing. However, if there's a European waterfall, this is entirely 200, this is entirely, I believe, 210. So only on this $10 into 20%, that is $2, will be paid if it is a European waterfall. What if investment 1 is sold in the first year and investment 2 in the second year? Then on the first investment in the first year, you will probably get $6, whether it is American or European, because it is the first year, and in the second year, if there is no clawback and there is a loss, none of the there will be nothing else. However, what if there is a clawback clause in, let us say, case B, A or B, whatever it is, in which case what will happen is, in case of a European it will not matter, but in case of an American, what I will do is, on the $20 loss on the second investment, $20 loss into 20%, that is equal to $4, will be clawed back. On the first investment I must have given $30 into 20%, that is equal to $6, and with a clawback clause later I will claw back $4. So there are other problems as well, but over here these are numerical questions which can probably help you understand these hurdle rates, these clauses slightly better, and that takes care of your reading number 77. Next is 78, which is investment in private equity, debt and equity both. So over here you will first start with private equity and then move on into private debt. So when I look at private equity, we are dividing this into three main categories. First is you're investing in directly into private companies directly, like in India, as we speak, National Stock Exchange or NSE is unlisted, but there are certain shares which are available where you can buy directly. Shares of NSE, which is an unlisted company, so you invest in a private company directly. Or the more common route where you can invest into a PE fund or a venture capital fund. Now the private equity funds over here can, at least outside India, do a lot of buyouts, and these buyouts are largely funded by a lot of debt which is taken in the company, which is generating cash flows, and they can pay off their debt. So these are called as leveraged buyouts or LBOs. If the management also joins the venture capital fund in running the new company, that is called as a management buyout. However, if the private equity company brings in its own management, removing the existing management structure, that is called as a management buy-in. So over here there can be leverage buyouts, can be split between management buyout and buy-in, and then there can be venture capital investment, which is common in startups or early stage companies. You can invest in shares or convertibles, etc. Next, when you go to stages in venture capital investing, so when you look at a venture capital investing, there are three stages where the investing can possibly happen. There can be what we call as a formative stage, which is a pre-seed stage, where a person just has an idea. Over here you have no product, no revenue, nothing, just an idea, and to make that idea a reality, maybe angel investors step in. Private equity or venture capital investors don't set up at this stage. We usually have angel investors over here, Next, you go to the seed capital stage. When you look at the seed capital stage over here, you need money, for example, into making a prototype or something for your product, and this is where for product development, marketing, etc. And hence this is where venture capital can possibly set in, or at least start to set in. Then you have the earlier startup stage where the product is made, you have started marketing it as well, and now you need money for operations, you need money to ramp up production. That is your early or a startup stage. Next, once you move out of the formative stage, you can go into the later or the expansion stage, where money may be needed for growth, for the purpose of diversification, for the purpose of marketing. This is a stage where usually founders end up losing control. And last is a mezzanine stage, where this is just the pre-IPO stage. Before IPO, there can be a bridge finance which is provided in the form of a short-term debt or maybe equity money. This is mezzanine, or the bridge financing between, let us say, the company going into an IPO. So over here, these are your typical stages in venture capital investing. At least in a country like ours, there are a lot of pipe investing. Pipe is private investing in public equity. Like, a lot of Indian founders don't want to give up control, and as a result, a lot of PE funds in India, which have traditionally globally been big buyout funds, settle for even minority stakes. The KKRs, the Blackstones, the Carlyles, most of them end up taking a 5, 10, 15, 30% stake in companies. So these are private equities investing in public equity, which is usually rare for a global audience. However, it is quite common per se in India. Then you have private equity exit strategies. Let us say a PE fund which has a life of anywhere between 5 to up to 10 years. How will a PE fund exit? It is not going to remain invested in a company till perpetuity. One of the most common routes over here is a trade sale. You find a strategic buyer. Like, if you have a PE fund in a particular consumer sector, you try to sell it to another big company in a consumer sector like a Nestle, a Procter & Gamble, or Hindustan Unilever. Thereby, they can be ready to even pay for synergies, and they can pay you a big amount. So one is something called as a trade sale. However, the buyers over here are quite limited, and hence if the trade sale does not go up, then one of the most common routes is public listing. Public listing over here can be a direct IPO, initial public offering, where new securities are issued to the public, or a direct listing where you list and the private equity fund sells the stock in that listed stock in the market only. The third, which is an emerging route, at least post-COVID, is an SPAC route, the special purpose acquisition companies. Now these are companies which are shell companies, blank check companies, which are exclusively found for the purpose of acquiring another company. So usually these SPAC companies would acquire private companies and merge the private companies with them, and thereby these private companies can get indirectly listed. Like, there is a fund manager who has good investment acumen. He sets up an SPAC. He is a sponsor for an SPAC, and this SPAC gets listed. Currently, it is a blank check company, and hence it does not have much of compliance. It directly gets itself listed. There's 18 to 24 months of time which is given for these people who have raised money in the SPAC, let's say of $200 million, to find acquisition targets, and these targets they will acquire. And so if I'm a private equity fund, I can sell my company to an SPAC who will indirectly merge my company with them and get listed. So exit to an SPAC is also a possible route, special purpose acquisition companies. Third, well, to be honest, this is not really an exit route, but it is given. Recapitalization means you're raising debt, you're raising money to distribute money, maybe distributing as dividend, but you're at least encashing some of your money through dividend. Fourth is secondary sale, where you get hold of another PE fund to sell your company to another PE fund. And last is, if nothing is working out, you might possibly liquidate the company as well, write off or liquidation. So these are the private equity exit strategies. When you look at the private equity fund risk and returns, so when I look at the private equity funds risk, over here, the risk and return over here, the returns are usually high, but the risk is also high, primarily because of the illiquidity, because of the leverage that is possibly there. The correlation is a little low, but again one can say this is biased because we don't have regular data on the valuation of these companies, and hence the correlation, the deviation may be biased a little low. The bias over here, like any other alternative investment of survivorship, backfill bias, is also there. So this is regarding private equity and venture capital, but you can also have private debt. Private debt over here can be direct lending, where you can lend to a private company. This is usually secured senior debt, And if someone needs it, a private company needs it, you can probably give private debt. Like if you see Shark Tank, sometimes these founders, apart from making equity investment, also give a line of credit or debt. So that is a private debt. Secondly, there can be venture debt, a venture capital fund giving a debt to a company. A lot of times a venture capital also wants the upside, and hence they can also have convertibles. So I'm giving you a debt now, but that has an option to convert into equity. So there can be convertibles as well. And then there is mezzanine debt. Mezzanine debt over here is generally subordinate. It is lower category debt, subordinate to senior debt, and they might also have convertible options. Then there is distressed debt over here. These are companies which are under distress, and in order to turn around they need money. So maybe they can raise money through debt which is in the form of distressed debt. And last is something called as a unitranche debt. Unitranche debt is somewhere between the direct lending, that is senior debt, and let us say mezzanine debt. It kind of clubs the debts of various risk profiles and tries to make, let us say, a debt. So this is called as a unitranche debt, combines different classes into a single loan. This is somewhere between a senior and a subordinated debt. The private debt is usually high risk, will also expect a high return. In terms of correlation, it is relatively low and hence gives a good diversification benefit. And for investing over here, you do need relatively good specialized knowledge. So if we look at a big fund who is investing its money, they will diversify across equity, across stock, and also across alternative investments where they can be a limited partners or invest in private equity, venture capital funds. But do they give diversification? Now usually the correlation ranges between 0.6 to 0.8 in most cases, but it is better to diversify across different vintages. The diversification over here is relatively less, I would say, as compared to other alternative investments, because you are still investing in equity. Venture capital may give you more diversification because it is unrelated to the market per se. Private equity might give you a relatively lesser diversification, especially if you're investing in listed stocks as well, like PIPE. The diversification over here is much low. We say that over here you should diversify across various vintages because we said that when the fund started is very important. So if you started during an expansion phase and if you made a lot of investments in expanding companies, then by the time you are exiting, these expanding companies would have grown, and hence you would make a stellar multi-bagger return. Or you were a vintage where the economy was suffering and you were a distressed fund, you acquired a lot of turnaround companies or distressed companies. By the time you exit, they would be at the stage of turnaround and you might be making a higher return. So if you have a vintage during an expansion period, you'll make a lot of returns if you invest in early stage. If you have a contractions vintage, then you'll make a high return if you invest in distressed companies which have a high possibility of turning around. Now the risk profile over here, when you go to see, the highest risk is on venture capital or angel investing, followed by private equity investing. Then when you go to debt, the mezzanine debt is much more riskier because it is the most subordinate, followed by unitranche debt, which is blended debt, then senior or direct debt, and then maybe real estate or infrastructure debt that we are going to do in the next chapter, because they have a fairly good degree of security. The real estate debt or infrastructure debt has a relatively good degree of security. So this is regarding the third reading, 78, regarding private capital. Next you go to other alternative investment classes. Now we go to real estate and infrastructure in reading number 79. So next we go to real estate and infrastructure. When you look at real estate, this is one of the most common classes that people invest. Now how do you invest in real estate? Like residential or commercial. Residential real estate would have houses, bungalows, etc. Commercial real estate would have warehouses, industrial complexes, offices, factories, etc. So the investment over here can be in the form of private or public. So private would be when you are directly investing in, let us say, certain properties, that is private. But if you're investing in stocks of real estate companies, that is public. So when I look at direct ownership or direct investment, that is private route to invest in real estate, or you can invest through partnerships as well. Here you need to ensure that you have enough property management expertise, because to maintain a property is kind of a headache. Your investment ticket size will be larger and a lot more illiquid. However, when you look at a public, like you can invest in something called as REITs, real estate investment trust. Now like a mutual fund for a stock, a REIT would be collecting money from a lot of investors and deploy that money directly, generally in real estate, and earn rental income. Over here, these units of the REIT will be listed and you can buy and sell these units of the REIT from the exchange. So when I look at REITs or maybe stocks of public companies, so there is no direct investments. You will invest through securities, maybe REITs, maybe equity of real estate stock, exchange traded funds, mortgage backed securities. You'll do that in fixed income, REITs, etc. The investment over here is smaller and a lot more liquid. So real estate investing can be through the private route, where you directly go and acquire property and that is not tradable, or through the public route, where you acquire a share of a real estate company like a DLF, Oberoi, etc. or Trump, for example, who runs a real estate business, or you acquire units of a ETF, a trust, a real estate investment trust, etc. Now, other way is you are getting an equity exposure or a debt exposure. Like when you look at private equity or private debt, you might invest in the equity of companies, or you might give loans to companies. In a similar way, real estate exposure can be an equity exposure where you are taking ownership of the property, in which case that is an equity ownership. However, you might give loans which is backed by security of the property, that is a mortgage. You are a lender, but there's a housing finance companies, they earn money and they give real estate loans, housing loans only. So over here you have maybe a lender or a debt exposure. So over here there can be equity or debt. Real estate investment can be direct, as we said. The benefits over here are we get control over the property. This gives us diversification because it has a relatively lower correlation. It is not listed as compared to those REITs, ETFs, stocks of companies which are relatively listed. And certain tax benefits, you get non-cash depreciation as deduction. Interest that you pay for this property is allowed as a tax deduction, and hence this can give you tax benefits. The drawbacks over here is the illiquidity, the big size, the property management that you have to manage. That is the relative drawback. When I look at indirect, this can be done through, let us say, where is this? This indirect idhar chalega is using partnerships, joint ventures, or investment in public traded stocks. The most important route, at least globally, has been real estate investment trust, which is the benefit over here. It is exempted from double taxation. So when, let us say, on the rent received by the REIT pays tax. Later, when the REIT distributes that money, the investors again don't have to pay tax. This is unlike a company, where if a company earns a profit, it pays tax, then it later distributes dividend, it again the investors have to pay tax. Here REITs are exempted from the double taxation, which is a big advantage. Second is they are exchange traded. That means they are highly liquid, and if someone wants to exit, they can quite easily exit these REITs as well. Now there are different types of REITs, which is an equity REIT, where the REIT invests and takes ownership of the properties, or there's a mortgage REIT where the REIT does not take ownership or equity in the properties. In fact, it gives loans and earns interest income. So equity REIT will invest directly in real estate, and a mortgage REIT will lend for real estate or mortgage backed securities. A hybrid REIT does both. When you look at a real estate investment trust, there are various investment strategies which can be followed by the REIT. Well, there can be an open-ended real estate investment trust with an indefinite life, something like a high quality commercial or residential properties. These are the common avenues. So usually REITs will invest in really good developments, really good properties, etc. Other than that, there can be certain risky strategies. These are usually close-ended and finite funds. There can be core plus real estate, value-added real estate, and opportunistic. When you look at core plus, you are going to invest in slightly bigger developments, value-added even bigger, and in the opportunistic one, the largest. And hence, like if you are aware, in India there was a project called as Lavasa. Now it has failed, but that project had 15 or 20,000 crores of investment. So if you are investing in Lavasa, it is like an opportunistic investing, or Gift City was an opportunity investing in a big project that you are investing. That is opportunistic investing by REIT. Value add would go into medium-sized projects, whereas the core plus real would take into a slightly more higher scale of development. The investment characteristic of REITs would be, for example, in terms of risk, the lowest would be your traditional mortgage REITs. After that, your equity REITs, the core strategies, and then value added and opportunistic being the most riskiest type of REITs which are there in the market. Like you have mutual funds, you have the large cap funds, mid cap funds, small cap funds, small cap being the most riskiest, large cap being the least riskiest in terms of at least these three. So when you look at REITs, they give you diversification, give you liquidity, much more correlation you can say, and uh, because it is listed and maybe helps you in improving the risk return profile of your investment as well. Characteristics of infrastructure. So this chapter covers real estate and it also covers infrastructure. So I believe we have discussed about real estate. Next you go to infrastructure. Now infrastructure investing over here would mean investing in infrastructure which can be a transportation asset like an airport, a road, a bridge, a highway, or a utility asset like, for example, a power facility, or information and communication technology asset like a telecom tower or a fiber optic network over here, or a social infrastructure asset which can include hospitals, schools, etc. So these are investments. Now the problem is, you will say that how will we invest? Now see, retail investors like you and me cannot directly invest. However, big sovereign funds, big funds can have a direct investment in certain roads or bridges, like the bullet train project. Japanese investors have investment in, for example, the bullet train project in India. So over here I can have investment directly in a particular infrastructure project. Now the question is, how will you make investments? One is, you will construct the asset yourself. Like the Bandra Worli ceiling in Bombay is constructed by a company called as HCC. So over here HCC will construct it. There are various ways in which it can earn return. It can sell it to the government, or it can operate it and earn toll revenue. So there are various ways. It can sell it to the government, lease it to the government, or operate directly and earn toll revenue. These types of projects are called as build, operate and transfer, BOT projects, where you can build, operate and then transfer, buy assets from the government directly, that is you will lease back, or you can operate directly. And then there is a public-private partnership, in which case the government as well as the private company come together to make an asset. So these are various ways. First, you might construct the asset yourself, or you buy the asset. Maybe there's an airport which is struggling. You buy the airport, you will turn around, reshape the airport, for example. Or you and the government come together, like some of the metro projects are a joint venture between the MMRDA in Mumbai, which is a government authority, and Reliance. So you will come together and make a particular project. So these are infrastructure investments, like Reliance has a metro in Mumbai, for example. So over here, these are the ways in which investments can be done. Cash flows from infrastructure investments. The most common cash flows are the usage-based cash flows, like toll revenue is usage-based. Availability based, which means if I make the infrastructure available to you, you have to pay me money for giving that availability. Then later you use it, you don't use it, I don't care. Like for example, Google Drive storage, you might get 15 GB free, but beyond that, if you want 100 GB, you will have to buy it. Now whether you use it or you don't use it, Google is providing, let us say if you call it, as infrastructure to you, and hence your payment that you have to make to Google is based on the availability that they are providing. Whether you use it or you don't use it does not really matter. And then you have take or pay, where you have to pay a minimum price to these entities who have made these infrastructure projects. Type of infrastructure investments can be greenfield. Greenfield means from scratch. So over here, like for example, there was an airport in Mumbai, then on the outskirts of Mumbai, Navi Mumbai, a new airport was going to build from scratch. That is a greenfield project. Whereas brownfield means there is already an airport already there, but it is not modern, it is not having the latest cutting edge technology. You kind of try to buy it and then revamp it. That is a brownfield. That is an airport already being there, and maybe you make some changes. So that is a brownfield. And third is secondary. Secondary means there's an airport company which is listed and you just buy shares in that airport company. You do nothing. So over here, greenfield is on a project which is yet to be constructed. Here you might have a build, operate, transfer, the maximum uncertainty and the most income generating potential. Brownfield, there's already some existing infrastructure which you would expand. This will give you stable cash flows, but again limited growth, and the least would be in fully operational existing assets where this is least risky and the lowest possible return. If you want stable cash flows, then brownfield is the best thing. If you're open to taking more risk, then greenfield investments can possibly be done. Now infrastructure projects over here, who are the people who are investing in infrastructure projects? The really big guys, the pension plans, insurance companies, the big sovereign wealth funds, the country's wealth funds who have enough money, hundreds of millions if not billions of dollars in a single investment. Well, these are usually people who are investing in infrastructure projects. The advantage of these projects would be that if there's a toll road project, it gives me 30-40 years of a relatively stable revenue. It has a much lower correlation as compared to every other thing with your traditional portfolio, because economy goes up or goes down, Sensex goes up or goes down, the toll collections will broadly remain the same, and hence the correlation is relatively lower. It gives you excellent diversification because of the low correlation, but it has a lot more risk, like a regulatory risk, a financial risk, constructing risk, operating risk. Like people might come and just destroy it. Like in Mumbai, MNS had went one day and they destroyed toll plazas. Said Mumbai people will not pay toll now. Whether it is ethical or not is debatable, but there are a lot of regulatory, operational, construction risks in these investments. Other problems over here are low liquidity, it's not as easy to exist, the relatively large cost, and very few publicly traded options over here. Unlike REITs, you don't have a trust or units for infrastructure investment. That takes care of reading number 79, which is on real estate and infrastructure. Next, you go to natural resources. So when you look at natural resources over here, there are three main things that are seen in the first part, and then commodities in the second part. So in the first part, you're talking about land. Over here, there can be raw land, like barren land. There can be farm land. In India, you can't buy agricultural land, but in the US and in most countries you can. So farmland, which over where crops are grown. And third is timberland, where there are big trees like the teak wood, timber plantations, where you can sell wood. So over here, there are three main: raw land, timberland, and farmland. The features over here is, again, they're highly liquid. Everything over here is, like they say in real estate as well, location, location, location. Everything is linked to the location, on how close you are from the market, from the sources of raw materials, from the sources of supply, etc. So location is very important, and very limited financing opportunities. Like for housing finance you will get, but for buying a timberland or raw land, you might not really get as much financing opportunities. Value drivers are proximity to transportation and markets, and because at least timberland and farmland have trees, maybe they can help in ESG, environment, social and governance. On the environment side, this can really help you in your ESG investing. Returns, usually the return is you can rent this land out and earn some rental income, or you can grow something on the land and earn income from the crops or the harvest that gets generated, apart from the capital appreciation that will be there for this land. So these are the sources of the return. Now, special features of a timberland are, like usually a lot of times farmlands can be owned by institutional investors, but most of the farmland is owned by individual people. But timberland largely can be held by a lot of institutional investors. The ticket size is quite large. It is bigger than a smaller farmland. When you look at timberland, institutional investors, again, this is probably the only place where you can decide when do you want to cut the trees. In terms of farmland, when the crop harvests, you have to cut it. However, here, the tree when to cut, when the wood prices, etc. are favorable. That is when you can decide the timing to harvest or cut the trees. You need a lot of special expertise to manage it, and hence there may be some timber investment management organizations which you can use for the purpose of management. Recently, there have been certain REITs which have also started for the purpose of investing in this asset class. These are the features of commodities and their investment characteristics. Now, the commodities over here, when you go to see metals, agriculture, energy, so there are various commodity grades. I mean, you can invest in metals, you can invest in agriculture. Metals would mean steel, copper, iron, etc. Agriculture would mean maybe you are investing in for example wheat, jawar, bajra, or energy where you are buying power, etc. Now, methods of commodity investing: one is again direct investing. You go and buy the commodity, but then you have to incur the storage costs, etc. So that becomes a little difficult to store all of this. One of the most common ways in which you can buy is through commodity derivatives, that is going through the MCX, NCDX, or internationally Chicago Mercantile Exchange, London Mercantile Exchange, and actually buying that commodity. So over here you can have direct investing like you do for gold in most cases, or commodity derivatives over here, which is the most common for the purpose of commodity futures, etc. that you will do, and other methods. Other methods can be exchange traded products or ETFs, which mimic the performance of commodities, or manage futures fund where you have commodity trading agents or special management agents to manage your commodity portfolio, and then there are specific funds for taking exposure of specific commodities. Again, in my opinion, most of the financial investors don't do direct investing. They may be doing it for gold, but other than that, most of them invest through commodity futures. And hence, like when you study in derivatives, you will want to find how do you find the theoretical futures price for a commodity futures. Now on this, there can be a numerical question that can be put in, like if I want to find the commodity futures price over here, let us say the commodity is at 1000. The commodity in the spot market is at 1000, and you want to find the futures price. You will say, well, the spot buyer will have to buy now and hence invest now, but the future buyer will buy in the future, and hence to that you will add the rate of interest. So let us say the rate of interest is 10% for 1 year, and hence theoretically the futures price should be 1100. However, the spot buyer, apart from investing 1000 and paying interest, if I don't have that money to invest 1000, will also have to pay for the storage cost. So over here maybe spot into the cost of carry plus the storage, and hence this should be your futures price. However, sometimes owning commodities, you can actually earn some income, earn some yield or return on owning the commodities, and as a result over here, when you look at a commodity transaction, there can be a convenience yield, and when I look at a convenience yield, that is the income that I can earn from holding the commodity. Maybe I can use the commodity for that 1 year as a spot buyer and earn it. A future buyer will not earn it, and hence maybe if there's a convenience yield, I will maybe subtract it. So over here your futures price will be 1100 plus 200 minus 250 will possibly come to what? 1050. Over here this is your commodity futures valuation. Now over here your spot price is 1000, your futures price is 1050. This situation where futures is greater than spot is called as contango. As you can see over here, the spot minus futures, if I do the formula, this is 1000 minus 1050, this is called as basis. If this is negative, spot minus futures, if this is negative, this situation is called as contango. However, if let's say the convenience yield is not 250, the convenience yield for example was 450, in which case 1100 1300, and hence can I say this is maybe 1300 minus, let's say this is 400, 1300 minus 400, let's say this will come to 900. So if I do spot minus future, this is 1000 minus 900, this will come to 100. This is called as backwardation, where spot is greater than the future. This situation will usually arise if the convenience yield is very high. This contango is arising when obviously there is storage cost, there is cost of carry, and convenience yield does not exceed that. But if the convenience yield is much higher, then the situation is called as a backwardation situation. This is also important over here. Analyze sources of risk, return and diversification among natural resource investment. So when I look at natural resources or commodities, the demand and supply is what determines their prices. I mean, when you look at the gold price, oil price, a lot of this is a fraction of demand and supply on how much is the value to the end users, what are the global conditions, price volatility, all that affects the demand. Supply can be affected by a lot of natural factors, like there is a tsunami, there is an earthquake, and supply can get disrupted. So production shortage, existing inventories, supply cannot be changed in the short term. So commodity prices, a very important thing is usually a hedge against inflation. If I don't know how much is going to be the inflation, but usually inflation arises because of commodity price increase, and as a result, if you are investing in commodities, you are generally hedged against the inflation. So one of the best inflation hedge is the commodity investing. Land etc. may not necessarily give you a hedge against inflation, but commodity investing in general will give you a hedge against inflation. The return of a commodity is high, but so is the volatility. Correlation is relatively low. Again, it depends on the type of commodity. If you have industrial commodities like oil, steel, maybe the correlation will be high with the Sensex and the industrial activity. But if you are having a general commodity, which like a wheat, jawar, bajra, or a food item, maybe the correlation will be relatively low. When you look at the timberland and farmland, again the returns are quite high, but the volatility or risk is quite low. Correlation is quite low. And all this because these are fairly few properties, few investors, large, illiquid, and hence their prices don't necessarily change in tandem with that of the market. Important for you in this chapter, what is important is your ability to calculate the commodity futures price, that is the spot price, into 1 plus the rate plus the storage minus the convenience yield. Your ability to figure out whether a particular market is in contango or backwardation. Spot minus futures, if it is negative, that is a contango, that is the future price is greater, that is a contango. But if spot minus futures is positive, that is a backwardation, which will usually arise if the convenience yield is relatively higher. Commodities give an excellent inflation hedge. Again, the returns risk is high for commodities, correlation is relatively low, and hence they give a good diversification benefits. We say there's an inflation hedge because there will be a direct relation. If the inflation is high, the commodities will outperform. If the inflation is low, commodities will underperform. And then we go on to the last two readings, which is on hedge funds and digital assets. So next we go to hedge funds. So when we look at hedge funds over here, these have a few very unique characteristics. We'll go to the classifications of hedge funds, but before that, a few unique characteristics that they possess is they are very less regulated as compared to even a mutual fund or a private equity fund. The level of regulation is very less because they are open only to qualified investors. The big investors are not open to the public at large, and hence over here the level of regulation is quite less. They don't have to disclose as much data, their strategies, etc., as compared to the other funds. Again, over here there is a lot of flexibility when it comes to the hedge funds, a lot of freedom that they have in terms of what they want to invest. They can go long, they can go short, they can change their strategies. A lot more freedom is given to the hedge funds, and they have flexible mandates. They're usually looked at on an absolute return basis. That means they can go long, they can go short. Now someone might say if the market is falling, you will also lose. Well, you will lose if you were long, that is you had bought. Had you gone short on the market and if the market is falling, you can actually make a money. And like private equity or venture capital are usually long. However, a hedge fund can even go short, and hence when we invest in hedge fund, we will look at an absolute return. We will not really look at return relative to, let us say, an index, and hence you will usually do the evaluation on a total return basis. The fees, like a private equity fund like 2/20 structure, are also relatively high. The fees are a percentage of assets under management over here and not just the committed capital. They can use leverage, they can use derivatives. Most of the times these hedge funds are privately held and the units of the hedge funds are not listed, and that is why they're relatively less regulated. And there is a much lower transparency because the level of disclosures to be given are much more lower. So these are the unique features of hedge funds as compared to the other funds. Now when we look at the various types of hedge fund investments, just a second please. So when we look at the various types of hedge fund investing, there are four main strategies in hedge funds. First, there is the equity strategy. Within the equities, first four strategies: the equity strategy, the event-driven strategies, relative value strategies, and opportunistic strategies. Within equity, there are 5 subparts. First, there is a fundamental long short, which means if the fundamentals showcase, you can go long. If the fundamentals showcase that they are overvalued, you can go short. And as a result, this is fundamental long short strategy, though there is a net long bias over here, that it will be net long usually. Then there is a fundamental growth and a fundamental value strategy. Like even if it is a growth strategy, you will go long or you will buy shares which are high growing. Even if they are expensive, that's fine. You will buy high growing shares. And in a fundamentally short, if they are slow growth or low growing stage, you will sell them. So it's a growth strategy where you will go long the high growth companies, short the low growth companies. Whereas if it is a fundamental value, which means if certain securities are undervalued, irrespective of their growth, you will buy. If they're overvalued, again irrespective of their growth, you will sell. So over here, you will go long the undervalued, you will go short the overvalued items. And next, so these are all strategies based on fundamentals. However, you can also use technical or even quantitative or quant analysis, algorithmic trading for your strategies as a hedge fund. So you will have a market neutral strategy where you will generally go long and short in approximately the same amount in such a way that your market risk gets neutralized. So your skill over here is to find those strategies which are likely to go up in the long and those securities which are likely to go short in the go down in the short strategy. So this is a market neutral, which is usually having this almost the same amount of long and short position. Then you have a strategy which is short bias. In a short bias, you are usually biased for short. So you are the type of investor who can pick up some drawback, lacuna, shortcomings, and hence you say that I'm not really good in picking up companies which are going to expand, do well, but I can easily point out, like an auditor does, that this is a company where there's a problem, in which case you will be a short bias investor, where you will try to pick up companies where you think they are going to go down and you short them. You might slide or go long for some amount, but by and large you're going to be having a net short exposure, and hence this is like a contrarian strategy. So this is first equity strategies. Second is event driven strategies, where you'll have mergers or demergers, spin-offs, distress, and based on those events you will build up strategy. So there's one strategy called as a merger arbitrage, in which case you will try to, if you know that there is a merger which is likely to happen, you will usually go long or buy the target company, because acquirer will usually pay a premium for that, and you will go short the acquiring company because usually the acquirers tend to overpay, and as a result their values don't rise as much. So over here you will buy the target company, sell the acquiring company. Then you will have a distressed restructuring, where you think that there is a company which is in distress, which is available at a very low value, and it is likely to turn around. You will buy those companies if there is a possibility of a successful restructuring. Third, you will look at activist shareholder strategy, where you will take a substantial stake, whereby you can actually create enough influence that you can mold strategy. So this is like acting as an activist investor. And then there is a special situations fund, where you will look at possible demergers, spin-offs, big distributions, buybacks, and accordingly try to invest in those companies which are likely to announce this buyback or a demerger, etc., and thereby make a profit. Next, you will have relative value strategies. The third one is relative value, where you are trying to exploit mispricings between two assets of a similar grade. Like for example, you can buy maybe an equity share and maybe go short the convertible debenture if the convertible debenture is significantly overpriced, or vice versa. So over here there can be a convertible arbitrage, where you are looking at the convertible bonds and the common stock discrepancy. Like the common stock is available at 100 and a convertible debenture is, for example, priced at 80, and this convertible debenture will convert into, let's say, 10 shares. So one share, for example, let's say the share is worth 10 rupees and convertible debenture is worth 80 rupees, and this convertible debenture converts into 10 shares. So by indirectly buying the convertible debenture for 80 and then converting into 10 shares, I can actually get 10 shares as 80 and then sell those 10 shares at 10 into 10, that is 100. So that is a convertible arbitrage. Or there can be arbitrage specific to, let us say, asset backed or mortgage backed securities in fixed income, which is a specific fixed income security. Or there can be a general fixed income arbitrage, where you might actually buy and sell shares of different issuers or shares or bonds of different quality. Fourth is a multi-strategy, where you will look at multiple asset classes and multiple markets, and wherever you identify discrepancies, so it is more like an arbitrage strategy, where you identify discrepancies in pricing, you can take a position. Next, you will have the opportunistic strategies, which are macro strategies. So when you look at opportunity strategies, this will look at macro events. Like when Trump announced a lot of tariffs, the market moved a lot. In some days Nasdaq fell down by 8 to 10%, some days it went up by 10 to 12%. And hence, if you are running a macro strategy which is based on big global factors, it will be turned by global events. It benefits in periods of high volatility, and if there is low volatility, the strategy is not as helpful. Another thing is managed futures, where you can do commodity trading, and in that commodity trading you can possibly the hedge fund can use it. So there are 4 strategies: equity, event driven, relative value, and opportunistic. Equity has growth, value, long short, market neutral, and it also has short bias. Event driven will have merger arbitrage, distress, special situations, as well as activist shareholder. In case of relative value, there will be specific fixed income, general fixed income, convertible, and a multi-asset arbitrage. And within macro, you will have opportunistic, you will have macro as well as managed futures. We have done the unique characteristics. Then the various investment forms and vehicles which are used in hedge fund investing, like a private equity fund. Even over here, limited partnerships or limited liability companies are used with indefinite life. usually 2 by 20 typical structure. Now there are two possible situations. One is as a commingled fund where you raise money from a lot of people, like a mutual fund, a lot of qualified investors, you raise money, and the general partner over here also itself invests the money. So in a commingled fund, the money is raised from a lot of people and the general partner himself or herself is also involved. Whereas in a separately managed account, if I have a fairly big amount like Mr. Money, I can recruit someone to manage that account for me. I don't need to raise money from 10 different people, in which case the fees relatively would be lower because these guys don't have to raise money from 10 different people, go running to find 10 different people. However, the fees would be lower, but at the same time the problem is alignment of interest, because in a separately managed account the fund manager is not put in his or her own money. It is very much possible the incentive is not as much like in a commingled fund where they have their own investment as well, and hence there is alignment of interest. So over here is regarding commingled and separately managed accounts. Then you have fund of funds where you are looking at an indirect investment, like I may be intimidated with so many hedge funds around me, so I don't know which are the good ones. Again, they don't disclose as much information for me to evaluate performance, and hence what I do is I give money to a fund of funds which will evaluate these hedge funds and invest money across these hedge funds. Now this fund of funds definitely gives me the diversification benefits, and if I have a small amount, this can implicitly help me by that one investment diversifying across various funds. However, there will be more fees because the hedge fund will charge their own 2 by 20 fees. The fund of fund over and above that will charge their own 1 by 10 fees, for example. So the additional fees will actually end up reducing the returns significantly. Last, analyze the source of risk, return and diversification. Now the risk and return over here, if you go to see for hedge funds, it's relatively high. But among other categories, this is one category where the correlation is not as low. Like in an infrastructure or real estate, the correlation is quite low. In hedge fund, because it is also going to invest in equity, the correlation cannot be said to be as low. In fact, it has a relatively decent correlation with traditional equity. So when I look at key points, hedge funds use leverage to magnify their fees back performance. It provides diversification, but there is more correlation with equity, and index returns again may be overstated, like those same survivorship, selection and backfill bias. The returns of a hedge fund can be broken down into three categories, like the market beta. If the market moves, the hedge fund will also get some return, whether they are long or short, if the market moves. So that is market beta. Second, the hedge fund may be involved in certain specific sectors, and as a result, the strategy beta over here would be the specific sectors that are performing. According to that, the hedge fund will make a return, and hence that is specific sectors. And lastly is the alpha, the hedge fund's ability to pick up how good a particular security that you have selected is going to be the alpha. So these are the three sources for the hedge fund. And then we go to the last reading over here, that is Introduction to Digital Assets. It's a fairly new reading over here, and over here you are going to study about a lot of new things in which are happening around, which is also an investment category. So when I look at digital assets, one of the most common applications or common uses will be distributed ledger technology, which is nothing but based on something what is a blockchain technology. So in a distributed ledger technology, what happens is, in a blockchain, it is a chain of various blocks. Now, if a particular transaction has to be added, the only way you can add it is one more block added to that chain. Like for example, if I were to buy a property, the first buyer's name will be on the name of the property, then that buyer sells, then that is a second block created. It sells to someone else, the third block created, the fourth block created, and so on. Traditionally, we go to a registrar and register the property, whereby we can see who is buying, who is selling, where is this property going. However, if you can decentralize, you can make a ledger where you show this chain of blocks, and you can make this ledger available to everyone who has the access code. So the data will be encrypted, like a lot of your lectures that you see are encrypted lectures. If you have the code, you can play those lectures. In a similar way, over here, this information, this ledger is distributed, which means it is available to everyone. However, this can be accessed to people who have the secret code to access that ledger. So the data is encrypted using cryptographic techniques, but it is decentralized. It is not centralized with a registrar or one authority, and hence it is a distributed ledger which is available to everyone. However, the question can be, I can always manipulate that ledger, so people will be misguided. This is where blockchain comes in, and blockchain says that I will have a consensus mechanism where there will be, let us say, there will be a way in which transactions will be validated. So if a block has to be added into a chain of transactions, that block has to be validated, and that validation happens using a consensus mechanism. Now, why would someone validate it? Well, the way the entire blockchain network works is that these people who are validating are called as miners or validators, and if they are given some complex cryptographic puzzles, and if they were to solve this, which will require a lot of computing power, then they will validate, they will be able to see whether this transaction is proper or not. And if more than 51% of the participants on the network consensus validate that transaction, that is when a block is added. Now the problem over here is once the block is added, it cannot be removed. These are immutable transactions, and once a block gets added, you cannot change it. You can add the next block, but you can't erase, edit or delete the earlier block, and hence there will be a clean chain of transactions. This consensus mechanism can be either using a proof of work concept where there will be decentralized machines across the world, and if they can validate the transactions, they will be rewarded in the form of cryptocurrency like a Bitcoin, or a proof of stake concept where they put some collateral, and if they are able to validate, they will get a return on that collateral again in the form of cryptocurrency. So when I look at digital assets are those assets which are electronically created, stored as well as transferred. They can be cryptographic items, tokens, digital collectibles. Remember, we are not tech guys over here, so we can have a broad understanding and proceed. If you want a detailed understanding, there will be a lot of YouTube videos which will help you in understanding this blockchain, cryptography, etc. So over here, there is a distributed ledger or blockchain technology, which the base of which is there will be an immutable ledger which is using cryptography. So there is a digital ledger. Information is sequentially recorded one after the other in blocks, and they are changed. New transaction can be added only after validation, and the validation happens using a consensus mechanism, which is either done using a proof of work, which is more common, or a proof of stake. Proof of work, miners will use cryptographic problems to verify, for which they will be rewarded by Bitcoin. In proof of stake, these validators will pledge a collateral, and if they can verify, they will get a return on that collateral. The network participants over here can be miners, validators, etc. These networks which are there are usually decentralized networks, and hence they are permissionless mostly. There is no permission required by one, like Facebook, Twitter, all of these are controlled by one central authority. Blockchain, Bitcoin is not controlled by anyone, and hence this is largely a permissionless. So then how is validation happen? Using consensus mechanism, that is proof of work or proof of stake. However, if you are not very convinced with this kind of permissionless network, you can always have a permission blockchain where certain users have authority, like approving transactions, editing or adding, in which case that network is called as a permission network. The permission network requires centralization, requires certain governance or administrative functions, and it is a little more cheaper to overall operate because there's one person who is responsible for doing validation, as opposed to a permissionless network where the network as a whole is responsible for doing validation, and hence a lot of people are trying to validate the same type of transactions. Digital asset categories, cryptocurrency and tokens. When I look at cryptocurrency over here, these will also use similar to blockchain technology. The four main things over here is you will have Bitcoins, which is the classic application on cryptocurrency, which is based on this digital currency with no central bank backing. There's no intermediary involved. Second is altcoins. These are alternative coins. Can be something like Ether, which is the base for a lot of smart contracts. Can be some other stable coins which have their values pegged with some other currency like dollars, like a Tether. Or they can also be meme coins like a Dogecoin, which is mainly for entertainment purposes. More than 80%, there are more than 10,000 cryptocurrencies, but more than 80% of these investment is in either Bitcoin or in Ether. There is also central bank digital currencies. A lot of central banks are evaluating having their own coins or a digital bank note. This is cryptocurrency. Next, there are tokens. Tokens are using digital mediums to display ownership. Like if there's a digital meme, using a blockchain, you can say that who is the owner of this meme. And if you want to be the owner, well, you can get a token, that is a chain in the blockchain, which showcases to everyone that you are the owner. And for that, you might pay money. So these are non-fungible tokens. That is, for tokens on getting ownership on digital artwork like a meme, for example, you're ready to pay. That is an NFT. Second is a security token. Like what works for these artworks can also work for shares. You don't need an exchange or anything, and hence someone can track who is the owner. So for that there will be a security token, and this tracks the ownership of stocks. This is much more cheaper, as we speak, is less regulated, and like an IPO, there can be an initial call of coin offering for that as well. The other two type of tokens are utility tokens or governance tokens. Now these are paid to network providers who are providing, like miners, validators, who are providing services. As we said, they will be rewarded in the form of Bitcoin. So these tokens are given to them, which is their reward for doing governance, that is managing the network, or doing utility, that is network services on the network. Explain features of digital assets and contrast them with other assets. Now, digital assets are growing greatly. Earlier there were close to 70 odd digital currencies a decade back. Now we have more than 10,000. The infrastructure is also developing, and a lot of institutional investors who are feeling the FOMO of being left out of this digital currency wave are also investing, and hence there is a lot of demand happening. However, the valuation over here is very challenging because there is no cash flow that is coming from these cryptocurrencies. Bitcoin, for example, has 21 million units of Bitcoin, and that's about it. And as a result, the value of Bitcoin cannot be derived from its cash flows, like economic features, and hence the valuation over here poses a lot of challenges, unlike a traditional assets which is based on discounted cash flow technologies. So valuation differences. Second, validation. Like earlier, validation used to be done by an exchange, by SEBI, by SEC, but here the validation is not done by a centralized authority, it is done by a consensus mechanism. The medium of exchange, usually if you were to buy a share, etc., payment will be made in a fiat currency, that is rupee, dollar, pound, etc. But on these digital assets, like you buy digital artwork, the payment will have to be made in Bitcoin, and as a result, the medium of payment is also these cryptocurrencies instead of fiat currencies, and the regulatory differences are there. While traditional assets are very strongly regulated, there is hardly any regulation for these currencies. Countries like US treat these cryptocurrencies similar to commodities. However, that is not uniform across all jurisdictions, and regulation is still evolving. Now, describe the investment forms and vehicles which can be used for digital assets. So I can invest directly, but if I want to invest directly, I'll need to have wallets. Like I need a demat account for a share, I'll need wallets where I can store this cryptocurrency on blockchain, and you get tokens on exchange if I were to buy. So this is if I were to directly buy. But how will I directly buy? I can buy through centralized exchanges like CoinDCX, WazirX, etc. These are exchanges where Bitcoins, Solana, Ether, all of these are traded using exchanges where price, data, volume, all of that is given. And second, using decentralized, where you will have some DApps or decentralization apps whereby through which you can buy. Because the entire base of blockchain is we don't need an intermediary, and exchange is an intermediary. So you can have centralized exchanges or even decentralized, though most of the trading does happen through the centralized ones. Now, what if I don't want a direct exposure? What if I want to do investment indirectly? How can I do that? Well, there are certain coin trusts which are there. Now, these are like mutual funds, exchange traded funds, or REITs, which will ultimately invest in cryptocurrencies, and they will give you units. So you will have units or shares in this coin trust, and this coin trust will invest in these cryptocurrencies. Here, you don't need these wallets or anything. A lot of people are reluctant to open demat account or open wallets, so they can invest in coin trust. Coin trust will give you shares, and these shares will be exposed to movement in cryptocurrencies. Or there can be futures, like US treats these currencies as commodities, and hence on the Chicago Mercantile Exchange you have even futures on the Bitcoin, but they are a lot more volatile because this is a new asset class. Or you can have an exchange traded fund which will mimic the performance of these digital assets, or you can invest in stocks of companies who are doing crypto mining, who are running a crypto exchange, or who is involved in this blockchain development. So this is investment through stocks. Or hedge funds which have a lot more flexibility. You are investing in these, you can invest, but you need to be careful because there are a lot of scam ICOs, pump and dump schemes, frauds, manipulation. If you forget the password, there's no way in which you can retrieve it back because there's no centralized authority. And for smaller cryptocurrencies, there'll be one big guy who is called as a whale who controls most of this, and hence they can manipulate the price. Okay. Next, you'll have digital investment in non-digital assets like a real estate. You can actually, earlier, if I have a 10-bedroom house, I don't have, but if I have it, I can either sell the entire house or none of it. However, if I create a blockchain type of a digital asset on the house, I can actually sell a part of the house, give fractional ownership to people if I just want to sell part of it, and hence this is very valuable. You can tokenize your assets. That is one big house. You can make 100 tokens out of it and give one token to people, which will give you liquidities. You can still control 60 tokens and give 40 tokens to others. So this can make illiquid assets like real estate a lot more liquid, increases liquidity, gives fractional ownership. This can also form a base for decentralized finance, where you develop financial products on a decentralized network using decentralized apps or DApps. The sources of risk, return and diversification, the return over here is generally very high. It is much higher than what the S&P 500 etc. is given. Bitcoin has gone up from $0.05 to all the way up to $65,000 in a matter of 10 to 15 years. But then the volatility or risk is also very high. So if you look at the risk adjusted return, it is almost the same, but the absolute return and absolute risk is much higher. But the diversification benefits are great. The correlation is quite low and the diversification benefits are great, and thereby there is a lot of possibility that because of this high degree of diversification benefits, people may invest in these crypto units, so that because their correlation is quite low, but in periods of extreme stress or extreme volatility, the correlation becomes high. So these are the things you need to consider. Other than that, a lot of very unique aspects like scarcity, market adoption, risk appetite, etc. should also be seen. So this kind of takes care of the theory based, including a few sums, revision for your alternative investments. I do hope this video has been helpful. If you do like it, please do share, like and comment. I've tried to focus a lot more on time as well as coverage. So yes, there would be certain sections which you might think could have been gone in depth, but again, the entire session, it will be like a regular lecture if you have to complete this in close to 1.5 hours, so that you get a quick overview. I think this revision should be helpful for you. I'll see you soon with other such videos. Till then, goodbye, good luck, and keep studying. Take care.